Yeah.
We're good for
I'm
sound?
just gonna do it. Test, test, test. 1, 2, 3, 4. We're good.
All right. Hey everybody, welcome to the Annapolis Valley Investor Meetup. I'm very excited tonight to be hosting you guys. We have two amazing speakers, Jason Conrad and Scott Gannon. I'll get into those a little bit after. Just to go over the agenda, so normally we will get Jonathan Bennett to do a market update. He's not here yet. We're going to do that probably last. He lets us know what's happening in the market around the valley. What you sometimes see sign-wise versus market-wise can be a little bit different, so he gives us a bit of insight there. I'm going to do a lending update, and then we're going to have Jason come up and speak. Jason is an accountant with a wealth of knowledge for structuring companies and saving you taxes, as well as giving you lots of tax-free money in retirement. Scott does the exact same thing, and what's really cool is these two work together, so it's amazing. They're different companies, but they just know how to help people. So I'm going to do a little bit of a lender update, and I don't have a slide or anything. I just talk about rates and where they're going and all that good stuff. So the Bank of Canada increased the key overnight rate last week by 0.25. Prime is at 6.7. I don't think I've ever seen it at 6.7 in 15 years, so it's the highest it's ever been. The kind of cool thing that's a little bit different that we're not used to, 5-year fixed rates and bond yields are down. So from October to now, our 5-year fixed rates are actually going in a downward fashion. So back in October, I was lending 5-year for 5% down at 5.44, and today I can get a 4.79. If you're borrowing variable, which is often the best way for people to borrow, you often can't qualify for that product now because of the simple fact that we have to use such a higher rate, plus 2% in order to qualify you. So it's kind of forcing people into, that must be JB, we're kind of forcing people into a fixed rate product, which is not my favorite thing to do today, because fixed rate products cost you money when you have to make a move within your 5-year period. So we're doing a little bit more 3-year, 2-year, 1-year. I'm moving a lot of people now from fixed rates into Manulife ones to carry them while the rates are high, and then when rates go back down, we can reassess and change their products at that time. So it's a very strange times. Normally the variable rate is way better than the fixed rate. Right now, people are qualifying for more on a fixed rate than they are on a variable, and it's really, really crappy. Even with the fixed rate, I am still using Manulife Bank for those mortgages because their penalty calculator is vastly different from TD, Scotia, and the Big Five. Manulife Bank will use actual rates, whereas TD and Scotia will use posted. So if you ever gotten a mortgage from Scotia or wherever, and you received a rate discount, if you get a deeply discounted mortgage and you break that mortgage, you're potentially paying that 1.5% to 2% discount. Flip it, and you're paying 2% per year that you have left on the mortgage, which can be cost prohibitive for people to get into new mortgages and or to make moves. So that's my lender update. If you guys have questions or whatever, if you want to talk about how you want to move your stuff around, Noelle and I had a meeting just before tonight, and if you're interested to figure out what's possible, anything is possible. You just have to be open. The rates honestly really suck right now. So it's a play by the year. If you're coming up for renewal, we're suggesting only going year to year. Why would you ever take a 5-year fix at this point? Unless you had to because of your ratios. So next up we have, and once we get done talking, guys, I want to go around the room as well to talk about the knowledge that's here, because I think it's important to understand that even with the speakers, but there's people here in the room as well that have a vast knowledge of investing that you guys can help each other. So, all right. So, other than being my neighbors nephew and kid who used to live in the basement next door to me. He's a big boy now, he's grown up. Jason Conrad is a CPA, CA, and is the president and owner of Conrad Tax Consultancy, a boutique tax firm focused on providing specialized tax solutions for individuals and business owners who value advice and its stability to allow them to better achieve their goals and objectives. Conrad Tax Consultancy recognizes the tax planning needs for each individual, business, or family are unique, which is why their planning is specifically tailored to meet the client's goals and objectives, while also providing for as much flexibility as possible to accommodate life's curveballs. So Jason's been doing this for quite some time. He was an accountant, did the day-to-day stuff at Belleville Vino for a number of years, became a partner there. But there's 2 of you in the province that do this job?
There's 2 on the South Shore.
2 on the South Shore that have this tax expertise. Jason's actually, this is not on here, but Jason's actually written tax law. So he's very well versed, and he also knows how to structure people for the best possible outcome for their real estate investing period. So without further ado, I'll let you come up here and
Sounds good.
yeah. So you just hit the button right there, I think, just touch that and you can
Perfect.
move things down.
Great. Thanks everyone for having me. It's a pleasure to be here tonight. So when I thought about what to talk about tonight, and I think about real estate investing, I immediately just thought about frequently asked questions. So there's 4 questions that I would say I get asked very frequently, and these are hands down the top 4 questions that I get from investors. And it's, should you claim capital cost allowance or shouldn't you? Seems to be a topic for discussion with virtually any new real estate investor I deal with. It seems to come up almost every year, over year, when doing tax filings as well. Capital improvement or expense, which tends to be, again, a question that comes up annually. People are looking to save tax. Is it something they can expense? Is it something that should be capitalized, depreciated over time? Whether or not you should incorporate, which is probably one of the most common ones I get. So we're going to dig into that one in a bit of depth, and that's going to naturally lead into the last one in terms of succession planning and how do you transfer the wealth of real estate investing onto your children tax efficiently. So what is capital cost allowance? So just briefly, capital cost allowance is basically a depreciation you get to claim on your annual tax return. So it's effectively a prescribed rate percentage of the undepreciated capital cost. So the undepreciated capital cost of a property is effectively the original purchase price that you paid for the property less the depreciation or CCA you've claimed to date. That's your undepreciated capital cost. And there's prescribed rate based on classes within the Income Tax Act. So the most common 2 you'll see with real estate investing would be Class 1, which is a building, which is a rate of 4%, and equipment, which is Class 8, and that's 20%. So that's usually like your appliances and things like that. So there's an example there just to kind of illustrate. So I did include in the example just to be clear that like if a property is acquired for $650,000, that also includes land. Land's non-depreciable. So you have to break out the allocation between land and building. So it's something that we see a lot when people acquire real estate. As accountants, we'll say, well, how much of it's attributable to land? I don't know. And oftentimes we tell them to go back and talk to the realtor and see if the realtor can maybe give them some sort of allocation of the breakdown. But the land is non-depreciable, so you have that as cost-based, but you can't depreciate it over time. So you can't claim capital cost allowance. So just to illustrate, if you bought a property for $650,000, say 150 is allocated to land, so you have 500 allocated to your building. In year 1, it's actually only 2%, even though the rate is 4%, and that's because of something called the half-year rule. So in the year of acquisition, you only get to depreciate half of the property. So if you acquired on January 1st, it's 50%. If you acquired on December 31st, it's the 50% rule. So that's just kind of how finance has determined they do it to kind of average out for you could buy middle of the year and so on. So $500,000 year 1 be $10,000 of depreciation, and then in year 2 is where you kind of get into the UCC. So it's effectively the $500 you paid in year 1 minus the $10 you claimed in year 1, which gives you your net of $490 at the 4% rate, which would be $19,600. So oftentimes what I hear people say is, well, if CCA gives me a tax deduction, why wouldn't I claim it? Wouldn't I just claim it all the time because it's saving me tax? The problem with claiming CCA, or the potential problem with claiming CCA, is something called recapture. So what happens is CCA is effectively a tax deferral mechanism, not a tax saving mechanism. The only way it's a tax savings mechanism is if it's truly a depreciable asset. So if you take something like a vehicle, generally vehicles depreciate, which means you're claiming depreciation, and then when you go to sell it, it's likely not going to be worth more than what you paid for it. It may not even be worth more than what your UCC is that you've claimed to date. Generally speaking, real estate appreciates, which means that if you claim CCA, you're going to end up with recapture when you sell it. So what recapture is effectively pulling back all the CCA you claimed into income. So CCA, in terms of real estate, is effectively a tax deferral mechanism. If it's referred to as a tax savings, I would argue that's not correct. It's almost always a tax deferral mechanism. So it's always going to come back into income over time. So if you use the same example we used before, $650,000 property, $500 was related to the building, $100,000 has been claimed over time. If that then, the building now is worth $650,000 when it's sold, all of that CCA you've claimed, that $100,000, comes back into income. So now you've got an income inclusion for $100,000, but that $100,000 is all in 1 year. So the depreciation you claimed may be over 4, 5, 6 years, whereas when the $100,000 comes back, it all hits you in 1 year. It usually doesn't stop there because real estate appreciates. So this actually increased $150,000 in value, which means you also have $150,000 capital gain, half of which is taxable, which means you've got a $75,000 capital gain that's taxable, plus $100,000 recapture. So now you're paying tax on $175,000 when you sell that property. So the reality is that if the marginal tax rate incurred on the recapture is higher than the tax rate you save when you claim depreciation, there's a net tax cost. So, in simplistic terms, if you're claiming CCA in a given year and your marginal tax rate in that year is 40%, but then in the year you sell it, you still have maybe your other ordinary income, so you're still in a 40% tax bracket normally, but you just added $175,000 of income. What's your tax rate now on the capital gain and the recapture? Probably 54%, the top marginal tax rate. So in that situation, you actually have a net tax cost of 14%. So it's actually costing you money, so that deferral is actually costing you money as opposed to saving tax at all. And like I said, that's typically what happens due to the tendency that real estate does appreciate in value. That's typically the case. The thing that I always try to have discussion with clients about, though, with claiming CCA is it can't always be just about the tax. Okay, so maybe it is going to be a net tax cost, and often in cases it will be a net tax cost. But particularly for real estate investors, sometimes cash flow is more important. So if you're claiming CCA along the way, you are alleviating the tax cost, which is improving your cash flow, and an improvement in cash flow may be more capital that you have available for investing into more properties. So maybe that cash flow, if you're taking that cash flow and you're properly leveraging it, so if you're leveraging that and you're financing 80% of a purchase, but now you've got extra cash flow that you're using into that deal, maybe that's actually generating a lot higher return, right? So maybe the cash flow is more important than the tax cost. So you always have to factor that in, right? I mean, if you're 80% leveraged on a property and your rate of return is 5, you're only 20% leveraged, so your actual rate of return is actually 20.
We'll believe you.
What was that?
I said, we'll believe you.
So in short, when does claiming CCA make sense? So I know I just went through a lot of stuff and maybe it's not all clear, but I think this slide kind of summarizes when does it actually make sense. So first and foremost, if you're otherwise in the top marginal personal tax rate, so if you're paying 54% on your income anyway, or very close to that top marginal rate, you should probably just claim CCA. The reason being is subject to our tax rates increasing. Lord, I hope they don't go any further. 54% is far too high to begin with, in my opinion. But if the tax rates stay at 54%, well, you're going to deduct at 54%, you're going to pay at 54%, but you're getting a deferral. So if you can get a deferral and it's the same tax rate, why not take the deferral, right? The other thing is, obviously, when you sell property, typically there is cash flow to fund the tax, whereas when you're investing in real estate, sometimes there's not necessarily cash flow to fund the tax, so that's where the cash flow becomes more important, which is basically item number 2, cash flow preservation overrides net tax costs. So that's, there's not really a formula for that, but it basically means that you have to analyze the fact that maybe there is going to be a net tax cost over time, but maybe cash flow truly is more important for you because at this point the capital that you're receiving from the deferral, that you're getting better cash flow from tax savings, that's going to give you the ability to invest in more property, which is going to grow that way. The other area is if you actually have no intention of selling real estate. Now, nobody has a crystal ball, but there are a lot of situations where people are looking to effectively create generational wealth. So you're buying real estate, you're living off the income that the real estate's generating, there is no intention to sell it, rather the intention is to pass it down through the generations. In that case, the tax deferral for you may be forever, or it may be your passing, depending on how you structure yourself. And you'll see when we get to the last section on succession planning, with proper planning, there actually are ways that you can potentially create generational wealth without tax at the time of one generation passing, with proper planning. Corporately owned real estate, and we're going to get into a bit more about how corporations are taxed, but for corporately owned real estate, it's basically flat taxed. So again, we'll get into how passive income's taxed inside a corporation, but it's effectively flat tax. So subject to the tax rate changing, it's kind of the same analogy as being at the top marginal personal tax rate. You're going to deduct at the corporate tax rate, you're going to pay at the same rate with recapture. So again, you're getting a deferral with no net tax cost. So real estate inside a corporation, I generally always claim CCA because there really is no net tax cost and you're getting basically a deferral. Again, subject to tax rate changes. The other thing I always point out too with CCA is there is a rule in the Income Tax Act that you can't claim CCA to create a loss. But that's applied on a global basis across rental property income. So it's not property by property. So what I mean by that is you can claim CCA on one property and that property itself has a loss, but another one has income. You can create a loss on one property to offset income of another one, but your rental income as a whole, you can't claim CCA to make it below zero, okay? The planning in there is that if you have a portfolio of properties and you can kind of look at them and say, well, I don't think that one I'm ever gonna sell, but that one there I may potentially sell. Well, the one you're never gonna sell, that's the one I'd be claiming maximum CCA on first, not the one that you may potentially sell, because anything that you may sell has got potential recapture. So just something to keep in mind. Capital or expense, again, this is a very common question to get all the time. This one here is pretty straightforward from a tax perspective, that if it's something you're able to expense, there's better tax benefits from expensing. It gives you an immediate expense, gives you immediate tax relief. The other thing is when you expense, it doesn't result in an increase to your capital costs, which means there's no recapture on that part. So if you add it to the cost base and you depreciate it, that's subject to potential recapture on sale. If you expense it, it doesn't add to the capital cost, so it's not subject to recapture. The other thing that's doing is, yes, your capital cost is lower because you didn't add it to your capital cost, but now when you go to sell it, it just means you have a larger capital gain, but capital gains are only 50% taxable. It's the best tax rate you can get. So if you can expense something, it is better from a tax perspective, but you do have to consider what does CRA, what does finance actually look at in making that determination. So these are kind of the three main things that we typically see when they're questioned. So the things that they're looking for is, did the value of the asset increase? Did you improve the longevity or the lifetime of the asset? And I would say the third one's probably the most important one that comes up more often than anything is, did it actually result in improved in quality, or was it literally just restoring it back to its original condition? So there's a couple examples up there, but what we commonly see is if you had 25-year asphalt shingles on a house and they need to be replaced and you put 25-year asphalt shingles on, I will argue that's an expense all day long, right? All you did was you restored it back to the same condition it was in. If you had 25-year asphalt shingles, you put a metal roof on, you probably got a bit of an argument on your hands to say that's an expense, not a capital improvement, because you've improved the quality of the building, you've improved the longevity, and you restored it to a condition that's better than what it originally was. So we don't see a lot of, in older homes you still see wooden windows, but wooden windows versus vinyl. Windows is where I've seen it before. You take wooden windows out, put vinyl windows in. I argue that's an improvement.
So what does it do to your tax if it is considered an improvement?
So if it's considered an improvement, you basically end up back in the capital cost allowance regime. So if you do a roof replacement and you add metal roof as opposed to asphalt shingles and it's $15,000, that gets added to your cost base, which goes into that same regime. So that $15,000 is an addition for this year, so you get to claim 2% of that $15,000 this year, and then that just goes right in your pool with your building, and it keeps basically spiraling through, so you can claim depreciation, and you get subject to recapture on sale, and so on. The one thing I always point out with this is an area that obviously has subjectivity. There are no clear answers. Anything that has subjectivity is more likely to be reviewed by CRA. So it is an area that you do want to use some caution. To me, it's always about having a conversation with the client, and basically I make a living by playing in the gray area. So in the Income Tax Act, there's black, there's white, and there's gray. I make money for playing in the gray. So the gray is basically the area where there's basically a position for what you're taking, but there's subjectivity. So you can't say for certain that CRA or finance would say, yes, that's absolutely the right way. You may have a bit of an argument, but you have the ability to make an argument. The other thing I always tell people is if you don't claim something, I've never in my life, and I don't think I ever will see a situation where CRA's come back and said, you know, you probably could have expensed that. Right? If you make the claim and you get a chance to argue it, worst case you're back to it being a capital improvement as opposed to an expense. So if, in my view, if a client understands the risk, they're willing to take the risk, and you're in the gray and there's an argument for the position you're taking, then in my opinion, that's fine. But if it's obviously something that's blatantly wrong or very aggressive, then, you know, it may be a different decision. Do you have a question?
Yeah, I was just curious, in your experience, is there any percentage of income that you would suggest keeping your, like, obviously to reduce your taxable income, you want to bulk up your repair and maintenance expenses. Is there any percentage of income that you suggest keeping your R&M expenses as a percentage of revenue below?
Not really. Basically what we're seeing in more recent years is where audits and CRA reviews are coming from is they're effectively starting to operate under the same mechanism that actual auditors do, like in public practice and stuff. And what they're doing is they're doing risk-based auditing. So it used to be that they would basically have like areas that they would look at and then they would start selecting people. What they're doing now is it's more risk-based. So what they're looking at is variances year over year. So if you had R&M last year 5,000, this year you got 15, that's potentially an area that their system, and most of the auditing you do now is computer generated. It's not from people looking at your returns. Most of it is systems picking up parameters that they put in, whether it's percentage increases, dollar increases year over year, and that's effectively what's happening. In a lot of cases, my understanding of what's happening is it's literally as much as the computer detects it, it prints the letter, and CRA actually has an automated mailing system that it takes the letter, it folds it, it goes right in an envelope, postage goes on, and it goes out. Nobody ever looks at it, right? So I mean, it is risk-based auditing. So it's not so much, I wouldn't say a percentage of revenue or anything, but variances year over year is more so what's triggering CRA to look at things now, as opposed to historically it was more like, well, we're going to look at vehicles because we think vehicles is an area where maybe there's some abuse or so on. Now it's more so those variances year over year. I can't say honestly that I see a lot of reviews though on rental property repair maintenance. I haven't seen a ton of them in my career, but again they are subjective, so they are a bit higher risk of being looked at.
So would you, like, let's say you had a horrible tenant and they just destroyed the place and you spent like $15,000 repairing it to bring it to the level it was,
Yep.
do you qualify that as an expense?
I would. If you've only brought it back to the level it was, then it's an expense.
Okay.
Yeah. If you've done something that's actually improved the property, then you really have to start considering what you've done.
Sounds like you're saying that may bring up that review, but at least you can defend
need
it.
that
You can
little
defend it,
chat
right?
bigger.
Yeah, the one thing,
Yeah.
the one thing where it does become a little bit more gray though is like if you buy a property, like let's say you buy a property and that property when you buy it, it needs windows, it needs some doors, it needs a new deck, and it needs shingles. In that situation, if it needs it when you bought it and you do it immediately after buying it, there's a lot stronger chance that CRA is going to argue that's a capital improvement. The reason being is they're going to argue that you bought it for suppressed value because it needed that work, and had that work been done, it would have been worth more when you bought it. Right? It's not a situation where you've owned it for a period of time, it's deteriorated during your ownership, and now you've brought it back to the condition. So that's something to just keep in mind when you are buying new properties.
What's that window, like, that they would say that? So how long would you wait?
There really isn't a window. To me, it's more like if it's done right after. I think if it's done, you know, even a year or two after sort of thing, it's less likely.
Yeah.
But there is no window to be able to say. It's basically the more time there is, the lower the risk is.
Yeah.
Is about all I could really say to that. The more the window.
It's one of those gray answers.
One of those gray. It's
Yeah,
like,
that's a gray area.
if you ask me anything in tax, the answer is it depends. It's always the right answer in tax. So should I incorporate? This is hands down, I would say, the number one question I get from real estate investors. And I think where it stems from a lot is you really have to understand how the corporate tax system works. So when people think of incorporation, they automatically attribute the low corporate tax rate of 11.5%, which is very attractive. So that's the tax rate that's available to active businesses, and that's the Nova Scotia rate. So when you're only paying 11.5% tax, it effectively means you've got 88.5 cents of every dollar you earn left to reinvest back. So the lowest marginal tax rate right now in Nova Scotia is 23.79%. So even if you're in the lowest marginal bracket, that's still providing you almost a 14% tax deferral. So it's substantial. So, you know, basically that's what that whole concept of tax deferral is effectively if you retain the income inside a corporation, you pay the low corporate tax rate, and you only pay personal tax when you take it out of the corporation. So the deferral, what they refer to as tax deferral, is effectively the difference between the two, because now you can control when you pay that personal tax. If you're taking that after-tax cash flow and you're investing it into something that can be with inside the corporation or another corporation within your structure, then you've got substantial tax deferral, substantially more capital that you can reinvest back because of the fact that you have 88.5 cents on every dollar. Here's the problem. 11.5% is only available to active businesses. And finance's view is that real estate investing is not an active business, it's passive. They consider it to be the same as taking your money and putting it in a GIC and earning interest. It's taxed the exact same way. So when income is taxed passively, it is substantially higher. Before I jump to what the tax rates are, I did just want to note two situations we don't see them arrive often, other than in kind of larger scale operations. If the business warrants more than 5 full-time equivalent employees, it's deemed active. So that's where you get like the Killam's of the world, and you know, these large companies that have multitude of employees, and hotels and things like that, because even hotels technically, if they're not providing other services, could be considered to be a passive business otherwise. So that's one. So basically if it's actually, you know, if there's evidence of it being larger scale, you have employees. The other situation is if it's basically being rented to an associated corporation. So this is a situation where you may have somebody who has an operating company and they're buying a building for their operating company but putting it in another company. If that's rented across, that's deemed active. And the basis for that is that if you just bought it inside your operating company, then you wouldn't even have this rent going back and forth, which means it would be deducted as active business income and so on. So what does it mean if it's passive? What's the tax rate? 52.67%. So that's the tax rate inside a corporation. Thing to keep in mind with that rate though, it does have two components. There's what I call a pure tax, which is the 22%, so that's a non-refundable tax. And then the 30.67% is refundable tax, which you may hear referred to as RDTOH, which stands for refundable dividend tax on hand. So the way it works is it's effectively a mechanism that finance has created to say, if you're going to earn passive income through a corporation, we don't want you to get tax deferral. That's effectively exactly what this model is designed. So top marginal personal tax rate in Nova Scotia, 54%. Passive income rate inside a corporation, 52.67. People aren't going to do planning for 1.3%, right? It's not enough of a tax deferral. But that's why they build in this refundable tax element, which effectively says if you distribute the income and the cash flow and you know the capital from that corporation to the shareholders, we'll give you some of that back. So when you pay dividends out of that corporation, you can recover the RDTOH. The rate is 38 1/3%, which effectively means for every $2.61 of dividends you pay, you get $1 of refundable dividend tax back. I know we're getting into the weeds a little here, but it is important to understand effectively how these taxes do work. The long and the short of it is that if you earn $1 of passive income directly personally and just pay 54% on it, or you earn the same dollar through the corporation, pay your 52.67, distribute it out, get back your refundable tax, you will pay more than 54% total. So the corporation will actually cost you tax. It will not save. And the reason is you will pay more tax on that dividend than the differential between the net tax at the corporate level of 22 and the 54% you'd otherwise just pay personally. So I know everything I'm telling you right now, everybody's saying, well, this doesn't make any sense. Why would you ever want to put real estate inside a corporation? So when does it actually make sense? So there's two primary areas where I would say it makes sense to own real estate inside a corporation.
Holdco or operating company?
Typically holding company.
Okay.
I would typically have it in a separate company.
Yep. Banks
Um,
like that too.
yeah, typically for one would be creditor protection, would be one area, so you're not commingling your liabilities. Usually your operating company, if you have another operating business, that's typically where your liability is, which means if you put the real estate in there, you're exposing the value of the real estate to that. You know, you can get really creative in, I don't want to get too far into the weeds, but you can get really creative if you want ultimate credit protection where you'd actually go with 3 companies as opposed to 2. And effectively what you do in that case is you always keep your real estate extremely highly leveraged, and your third company is effectively just a holding company, which I refer to as the bank corp, and you strip all the value out of your real estate company to your bank corp and become a secured creditor in yourself. And by doing that, you've effectively achieved really good creditor protection because secured creditors get paid before anybody else does. So if the liability comes on your real estate, you pay yourself first. So, and again, it just depends on how far you want to go with it. So situation one where it definitely makes sense is if you have a person who has an operating business and they're using the cash flow from that operating business to fund the real estate. So this goes back to the tax deferral. So let's say somebody has an operating business, they take out what they need to live on, but they have an extra $100,000 of income from their operations. They only pay 11.5% tax on it. They get $88,500 left over to invest in something. If you want to own real estate personally, you got to take that $88,500, go to the company, pay tax on it, and if you're lucky, you're going to have $50,000 of it left to invest in real estate. Instead, you can use the whole $88,500 corporately to invest in real estate. So you've just substantially increased the capital that you have available for investing. So in situations where basically there's an operating business, they're accessing the low corporate tax rate on their operating business, that business is generating cash flow that they're otherwise using to invest in real estate, it absolutely makes sense to own the real estate corporately. Probably not in the same company as the operating company, probably in a separate holding company. And I don't have structures and stuff here to do that, but there are structures that you can move that money around easily. But definitely an area where it makes sense. The other area, which is where we're going to jump into now, is basically succession planning. So the other area where corporations make really good sense is if it's a situation where you're basically trying to transfer that wealth to the next generation. And we're going to jump in and I'm going to kind of go through and try to explain to you as simplistically as I can how you can basically use corporations to transfer wealth through multiple generations. So you've probably heard of a business trust or a family trust before. The terms are used kind of interchangeably. Business trust is becoming more common, family trust used to be. Basically, you can use a trust to allow the value of a corporation to accrue to the trust, and the benefit of it accruing to the trust is that value can effectively go to any of the beneficiaries tax-free. It can be distributed to them tax-free. But the trustee of the trust, which would typically be the primary owner or investor, they still have full control. So you don't lose any control, but you get all the added flexibility of being able to give that value to whoever you want to. Typically, the beneficiaries would obviously include your children, so you can kind of see where this is leading into. One thing about the trust you have to keep in mind that they do have a limited lifetime of 21 years. So what happens is that trust at its 21st anniversary is deemed to dispose of everything it owns, which means that if you set up a trust and you get $2 million of value accruing to that trust and then you don't do anything on its 21st anniversary, you get $2 million capital gain. So they do have a limited lifetime of 21 years. The one thing I would note though is that even though it has a limited lifetime of 21 years, if you're at a point where you say, I'm not going to want to give this to my kids in 21 years, it doesn't necessarily mean that you shouldn't consider incorporation now anyway. The reason for that is if you start accumulating real estate personally and say, I'm going to wait until I'm within that 21-year window, I refer to it as, before I incorporate, if you own all this real estate now personally, you've now got to get it into a corporation. That's expensive. You're going to pay me and you're going to pay a lawyer to help you figure out how to structure it so you can do it without tax. Then you're going to have to work with Leanne on all the financing, because now you're going from a bunch of personal mortgages into corporations, so you got to deal with your lending side. If you're in an area where there's D-transfer tax, you got to pay D-transfer tax on the fair market value. After you register the new deed, they now know what the property's worth, because that fair market value, so your property taxes might go up. So it becomes very expensive. So even though it may be more than 21 years out before you may actually want to transition this to the next generation, it may be that even, now maybe it's somebody in their 30s, they're starting to invest in real estate, but this is their long-term goal. Maybe it still makes sense to consider incorporation now, so that it's inside the corporation, and then we can restructure when we get to that 21-year window, which is effectively what we're going to talk about. So there's a way to bring a trust in after. So if you have a corporation that owns a bunch of real estate, you get through a period of time, it's accumulating value, now you want to bring a trust in. It's a transaction that's called a freeze, we refer to it as. Effectively what a freeze is it's literally just that. You take the company on today, you look at what the value is, say it's worth $2 million, you freeze it. So the shareholder today owns the common shares, they're worth $2 million. They exchange those shares for preferred shares. They get preferred shares worth $2 million. Now all of the value of that company is in the preferred shares. The common shares now have no value. So the trust can subscribe for new common shares at nominal value, which gets the trust into ownership. So what that does is it allows all of the future value to accrue to the trust. With proper planning, you can actually take some of the existing value and push it into the trust, which is called a wasting freeze. So effectively what happens in a wasting freeze is over time, those preferred shares you received, you redeem them away. So what that means is you effectively have the corporation buy them back from you. When it buys back the shares, it reduces the value that you now have. So let's say it's $2 million. You're going to take $100,000. You want $100,000 of dividend income that year. So you have the corporation buy back $100,000 of preferred shares. You end up with a deemed dividend of $100,000. Now your shares are worth 1.9, not 2 million. So to try to make this make sense, we're going to go through an example, and I'm going to try to illustrate to you how powerful a wasting freeze can be. And this example is actually built on something that's relatively similar to something I've actually seen work through over a 15-year period. So Mr. A owns 100 common shares of Realco. Realco is currently worth $2 million, but over the next 15 years, it's going to grow to $4 million. He presently takes $100,000 of annual dividends from Realco, and he suddenly passes away 15 years from now, leaving Realco to his children. So if we do a freeze today, Mr. A gets preferred shares worth $2 million, and then we let the trust come in for the new common shares, initially having no value. Over 15 years, Mr. A redeems $100,000 of preferred shares each year. So over those 15 years, he's going to redeem $1.5 million of his $2 million of value. So after 15 years, his preferred shares are now worth $500,000. Mr. A passes away 15 years later. He's got $500,000 of preferred shares deemed to be disposed of when he passes away. Mr. A has potentially $135,000 tax bill. That's a good number.
Not really, but sure.
It's a lot better than this one.
Oh,
So if you do it that way with a wasting freeze, remember Realco's now worth $4 million. His preferred shares are only worth $500,000. The other $3.5 million is now in the trust. So that's the concept of a wasting freeze, because effectively what's happening in that situation is Mr. A historically takes a $100,000 dividend, and that's basically just the income that the corporation's generated. But instead what we're saying is, no, we're not going to give Mr. A dividend from the income. We're going to give Mr. A dividend from his preferred shares, which allows the income to be retained to the commons. So Mr. A's value comes down and the trust value starts going up. So at the end of 15 years, the trust now has $3.5 million of value, even though during that 15-year period, the company only grew by $2 million. But we managed to get another $1.5 million of value in the trust, which is effectively shifted from Mr. A just through tax planning and the way we structured his income. So in that situation, Mr. A's children would receive those shares from the trust, fully tax deferred, and they would only pay tax when they dispose of those shares. So if they hold those shares until they pass away, that's potentially a tax deferral for 2 generations. So Mr. A and then his kids. And then his kids could do the same planning, which in theory, with the right facts, that they could do it, and then you could do it for another generation. Again, it's all fact dependent. But the real thing that illustrates this is, let's say the freeze wasn't done. If the freeze wasn't done, Mr. A owns shares worth $4 million now, because that's what the company's worth in 15 years. Mr. A passes away holding shares of $4 million, deemed disposition, $4 million capital gain, $2 million taxable. That's potentially what his tax bill is, $1.08 million. It's a $945,000 tax deferral.
That's tax planning.
It's substantial. The other thing I did want to point out is, because that's obviously based on Mr. A dying, but what if Mr. A lives past 21 years? So when you get coming up to that 21st anniversary, Mr. A, as I mentioned, he has full control. So one option is maybe he's at a point where he says, I got $500,000 of preferred shares, that's enough to get me through the rest of my lifetime, I don't need any more cash flow than that. I'm just going to give them to my children. So if he gives the common shares to his children, they each get $1.75 million of common shares, they pay no tax, they don't pay any tax till they dispose of those shares. And then again, they could go down this path of doing the planning themselves. The other option is, which would probably be foolish at that point, but he could just take all the shares himself. If you do that, you effectively just undid all the planning. And you're back to, right? But it's to illustrate the fact that Mr. A has full control, right? He's the one who dictates what happens. So you get all the added flexibility, no loss of control.
So question, the 21 years, if he dies and it goes to the next generation, their 21 years are still in that
So
21 years?
No, so at that point, the trust would be wound up. So then you're outside of this 21-year window.
Okay,
Because the 21 years applies to the trust.
okay.
So now they own the shares, and now it's up to them to do their own planning. If they just continue to hold them and it continues to accumulate in value, then when they pass away, they're going to have a big tax liability because now they've got all that value personally themselves. Alternatively, they could basically go back and start doing the same planning again. They could freeze themselves off, bring a trust in for their children, and so on. So just a couple things in closing, particularly with succession planning, always think ahead. By its very nature, succession planning means you're looking forward, not backwards. You have to look to ultimately where you're trying to get to. As Leanne mentioned, kind of in terms of how, the planning that I do and how I operate, for me, mission critical, anytime I deal with a client, I have to know what your objectives are. If I don't know what your goals and objectives are, can't help you. 100% of a proper plan, in my opinion, is entirely built around determining what your goals and objectives are. That's what we're always trying to achieve. And you have to look at today and you have to look at the future, because with proper planning, as you just saw, we took a situation where Mr. A could potentially defer $945,000 of tax, or if he decides I don't want to give it to my kids, I don't like them anymore, he can just undo it all and he can take it all back. So it's the flexibility. So a proper tax planning typically includes as much flexibility as you can build in. It's not to say you can always build in unlimited flexibility, but the flexibility is the key. But you always have to be looking ahead. You can't just look at today, you have to look long term. And building in that flexibility will typically allow you to adapt and move forward. Whereas if you just look at today, typically what's going to happen is you're going to spend way more in professional fees, because you're going to fix something today, and then in 2 years later you're going to come back and then you're going to pay me again to fix it. Well, not me, because I won't do it. If I don't have the goals and objectives to be able to look forward, I actually won't do that planning, because to me it's doing a disservice to the client. If you're not getting the full picture and you're not seeing everything, you're likely going to end up in a situation where you're just going to keep paying over and over and over again, because you're basically trying to do baby steps instead of looking at a planned situation as a whole and build in flexibility. The other thing, particularly with real estate, liquidity, liquidity, liquidity. Real estate is not liquid, okay? If you're in a market, like we were in not too long ago, one might argue it's liquid. You can just as quickly be in a situation where it's not liquid at all. So particularly when you're doing succession planning, I see it all the time with real estate investors. I want to leave the real estate to my children. Okay, who's going to pay the tax? Where's the money going to come from to pay all this tax? What else do you have? Everything they have is tied up in real estate. Where's the liquidity? So the very asset that you want to leave your children, you're leaving them a liability. Because they're going to have tax, they're going to have to liquidate the real estate to pay the tax, and you're not actually leaving them what you think you are. You're literally just going to create a vicious ball. So you have to be always thinking about the liquidity, whether it's other liquid assets to cover the tax, or, as I'm sure Scott's going to talk about, life insurance can definitely be your friend here. So life insurance, in my opinion, I see life insurance very, very useful to real estate investors for the very reason that liquidity is often an issue, especially when you're looking at succession planning and estate planning situations. That's all I got.
Wow.
No?
Is that all? you guys can all see why it's important to have somebody that knows what they're doing when it comes to your taxes and your tax savings when you're doing real estate. It's hugely important. So Jason doesn't prepare tax returns, do all that stuff. He literally just does tax planning. And I'm a big fan of life insurance, as Scott knows. And the facets of that, we're going to share that with you as well through Scott's presentation and how that works and how you can get two uses for the same dollar. And I always like to share the story about the richest woman I ever met, who was making, I think it was $8,000 a month, and I got her tax return and it was all zeros. It was all tax-free money. And who doesn't like tax-free money? So anyway, do you guys, we'll allow like a couple minutes for questions for Jason, and then we're going to move on to Scott. Anyone? Go ahead.
So you talked about risk aversion in triggering a tax audit.
Mm-hmm.
When you're doing the Section 85 rollover into the corporation with your property,
Yeah.
or you're doing the waste and freeze or the freeze, in the perspective of CRA, do they look at that as a triggering, like there's going to be a significant difference from your personal tax that goes into your corporate tax? Are they going to, jump on you and say, produce all of this paperwork and this rollover? And
I've never seen it been a cause for any type of audits.
Okay.
Typically, the most frequent areas where because a lot of that stuff, so on the Section 85 rollover, a lot of that, like that election filing is really just an information filing.
Okay.
And one of the biggest things on that has any subjectivity to it is the fair market value. So, that's really kind of the only subjective piece. Honestly, in my career, I've never had a T2057 reviewed, right? I've been doing this for 14 years, and I file probably 10 to 15 2057s a month.
Yeah.
I've never had one reviewed, other than somebody asking a question for something that's on.
Right.
Typically, where the most common area where I see any type of value subjectivity is usually when somebody passes away.
Yeah.
That's where, because when somebody passes away, they're automatically scrutinizing because you're requesting the clearance certificate,
Yeah.
which is kind of like CRA's last kick at the can, so to speak. So that's where it kind of becomes more subjective. But a wasting freeze, like there's really nothing in there that would cause them to want to look. It's just a redemption of shares, dividend income going out to them.
Okay.
Other than the valuation on the freeze itself. So when you do the freeze, you do have to properly value that company.
Okay.
So there should be a valuation done on the shares.
Right.
And then of course that means you also need to value the real estate, which means somehow you have to come up with that value of the real estate, whether it's yourself talking with a realtor, formal appraisals, et cetera.
Yeah. Yeah. And the part that worries me too on the rollover is that it's going to make such a difference in your personal income tax also in that rollover year. And then, it always worries you if you're going to have to, when
Yeah.
the auditors come in and saying, hey, how come you don't have those buildings listed on your personal income tax anymore because you rolled it over?
Well, I think that's part of the reason why the 2057 exists actually for the Section 85 rollover.
Yeah.
Because if CRA sees that last year had rental income, this year you don't,
Yeah.
they have a 2057 that shows you transferred the properties.
There you go.
So it actually makes the question disappear.
Mhm.
Whereas if that election filing didn't exist,
Mhm.
they may raise that question. But yeah, I mean, if you had a property last year and you don't have it this year, CRA, I can't say for sure, but their system is probably cross-referencing to say, is it on a 2057 or was it disposed of last year?
Okay.
And if one of those two don't exist,
Yeah.
then yeah, it's probably gonna get reviewed.
Yeah, which is kind of problematic too, especially if you go in with your corporation and change the year end and you're not on the traditional year end.
Yeah.
So, yeah, okay.
That's why I hire somebody like him.
So I only have one other, just on the succession also. When you're doing your succession, is it better if there is tax to be paid to leave it in the estate and have the estate pay it as opposed to having it rolled over into the recovery of the value of the property into to the child that you pass the real estate on, if that's the situation, you have real estate left over?
Yeah,
When you recommend that,
it more so depends on what the children are gonna do with it.
yeah.
And that's actually, like I didn't mention there, but that's actually one of the things that I always discuss with clients as well, is when I hear clients say, I want to leave the real estate to the children, usually my immediate question is, have you talked to them about it? Because if they don't want it, sometimes, like, because of the way planning works and the way the tax system works, if they're going to immediately liquidate that real estate, you would actually be better off to never have done a wasting freeze. You'd be better off to trigger the 1.08 million in tax when that person passes away, if they're going to then immediately liquidate it, than you would be to defer it. Because in that case, your deferral is so short, and the problem is that you're taking, what you're deferring is you're avoiding a capital gain,
Mm-hmm,
and you're gonna end up with dividends.
yeah.
Capital gains are better than dividends.
Right.
So it is important to have those conversations when you're looking at succession planning. Sometimes what you think your children want, they don't actually want. And I think it's actually more common now
Mhm.
to see, in my experience, it's actually more common now to see the next generation not want to do what their parents did than it used to be,
Yeah.
right? It used to be that a lot of people followed, and now I find, in my experience anyway, there's a lot of situations where I hear a lot of the comments of, I don't want to have to work near as hard as my dad did or my mother did, right? I want to do something completely different. So, you know, I do think it's important that you have those discussions as part of succession planning and estate planning. Because if your children don't want it, then it's kind of a different plan,
Yeah.
right?
Okay, thank you.
Yeah.
Thank you.
Awesome. Thank you, Jason. And I think we need to have another discussion around financing when you do all these changes as well. And we can set that up for you guys. I'll probably get like a commercial broker to come in and talk about the difference with residential versus commercial and how you can grow and those kinds of things. So
It's not just a name change.
no. Thank you, Jason. That was amazing. He always makes tax planning sound interesting, and I just my eyes glaze over, and I get some of it. I don't get other parts, but Jason knows what he's doing. He's opened up his own tax planning office. If you guys want his information, we'll post it on the Home Ec site so you guys can get it in there. So thank you. So next up, we have Scott Gannon, and then following him, we're going to do our market update with Jonathan. So Scott Gannon is the founder of and wealth coach for Scott Gannon Financial. He has a finance and accounting degree from St. Mary's, as well as several industry designations. Scott's been in the business for 28 years, and he's learning every day. I'm going to add to that. I've been working with Scott for a few years now. Scott is not your typical financial planner. Most financial planners want you to sock away money into RSPs and buy life insurance. They're asset gatherers and they're insurance salesmen. Scott is not that person. He is a person that looks at wealth building, asset building, and then protecting it with the life insurance. So, over to you, Scott. Okay, you are.
Thank you, Leanne. And thank you all for coming. You're proud here tonight.
I am going to put you on a timer, though.
Well, on a timer.
Yeah.
Yeah, well,
Yeah, 25 minutes, you're good.
oh no, I'm good.
You're
It's short, it's only 10 slides. and
Okay, go.
So I kind of changed it up. I've done similar kind of presentations like this before, but actually it's kind of funny. It's only 10 slides, and I took pieces from 4 other presentations that I've done. So, but what I've done is kept it very, I guess, high level, basically. And if you want to learn more, just give me a call. I'm no obligation, nothing. I can teach anything you want to know about this, because it is something unique for sure. Okay, so what are problems with money? Short-term problems. I cut off. Oh no, it's not. Okay. Real estate investors need safety and control of their liquidity. Why? Well, because shit happens. And if you want to be able to deal with it, like a pandemic, interesting conversation now, you got to have cash available on demand. Now, why do real estates want safety and control of their liquidity? Take advantage of the deal of a lifetime, or take advantage of opportunities. When does the deal of a lifetime happen? Anybody care to answer that?
What do you do with money?
Somebody has a great deal or a great idea and needs money. If you have control of your liquidity, you could be that money person. So you could be in on the deal of a lifetime without the idea. Medium and long-term problems. Real estate investors want tax efficiency, with passive income whenever possible. Why? Of course, he talked about general disdain for overpaying in taxes, but passive income rules are insane. Jason didn't elaborate more on that, because that goes even further when you have 50,000 of more than passive. If you're over $50,000 in passive income, then it's a weird calculation that you end up paying more tax than you actually earn in interest. So it's kind of crazy. And I did take one of this is from another presentation, so I did take a third slide away that I feel like I should have left in there when you talked a lot about succession planning. Is the third one talks about long-term planning or legacy, and how they intertwine, which you kind of mentioned as well. So, like I said, I'm happy to discuss all this stuff anytime. Oh, did I skip one there? No. Okay. 2 biggest wealth destroyers. First one, lost opportunity cost. So what this isn't hooking up the way it was when I read it over to myself, but essentially, so talking about having liquidity, what I do to create liquidity is use a very specifically designed life insurance policy to allow you to kind of create your bank of your own. And what happens is you don't have lost opportunity costs. If you have, I'll use a simple example, you have 50 grand you want to put into a property. You take that cash and you put a down payment on the property and you buy it, whatever, 250,000, 20% down. That money is now in the property, that's the only place it is. Now, if you look at it, if this is your 50 grand over time, to make your real estate investment and it goes, whatever, let's just say this is 100 grand, and then now you're taking 50 out. Now you've forever stopped the growth of that original 100 grand. Now this investment may make you gobs of money, and hopefully it does. But the original money you have is not leveraged, so it's only in one place. Real estate investors, one of the first things you learn is leverage is what's gonna get you those outsized returns. This is just another way to leverage, but it's a very safe way to leverage. Again, the second one, so on. So lost opportunity cost is, by definition, is what you could have earned on the money had you not used it for whatever you did, or for whatever you used it for. So if you could find a way to keep that growing forever, and that's the plan here, is end of life, then you will, basically your money is uninterrupted compounding growth forever. That's
Two
it.
uses for the same dollar.
Yeah, when Leanne mentioned that about the two uses, so now your money's growing in two places. It should be growing in your real estate, and definitely, by contract, will guarantee inside of life insurance policy, it gets better every single day, and that's guaranteed. Second is taxes, which Jason had a very good conversation with taxes. Here we're tax. Tax on rents, tax on investments and earning growth, corporate dividends, which has a refund mechanism apparently, and when obviously taking income. So these are the two areas like when I put this together, I was just like, okay, what are the two things that people hate the most? Two people think, or one person hates. Oh my lord! Sorry guys.
All good.
Everybody hates taxes, but these are truly the two wealth destroyers. I should go back and talk a little bit more about the lost opportunity cost, because it really is real. Because understand that once it's gone forever. But taxes, same way. Actually, can I reverse on this thing?
Yep. Hit the up arrow.
The up arrow?
Yep.
So if
There
you
you
go
go.
back here, you got money in your account, and you get a tax bill, well, that's forever gone as well. Same idea as if you put money into a property, although that's an investment, taxes are a real expense, okay? So this can take away too. Like for instance, in my own, once I learned how to do this myself, believe me, I've been around 28 years and I've only learned about this 7 years ago myself. And when, 2017 I think it was, I took an average of my corporate tax for the prior 3 years. And took that number and took that and made a premium deposit for a life insurance policy on that exact number. The idea being is that I would always use the insurance policy as a mechanism to pay my taxes. I don't pay my taxes quarterly. I continuously owe the money. That's why they leave me alone for the most part. And so what I do is I put the money in there, and then the following year when the taxes come due, I borrow against the insurance policy, write a check for taxes. All the while the money's growing. Now, I am accumulating a debt in there with the intention of a windfall. See, I have an operating business, and when I sell a portion of that, which I will likely do this year, the money part of my business, then I take that windfall and then pay it all back. The great thing about having debt against these insurance policies, understand that this is debt too, like the 2 used dollars thing, your money's still growing. So you're borrowing the insurance company's money. So that is a real debt. But what it does is it keeps your money growing. So anyway, that's a long way to explain that I've used the biggest, in my mind, aside from a lost opportunity cost, tax, as my first kind of target, if you will, of this is an expense that I don't want to have to just give away my money forever. So now I'm recapturing that money every single year. Okay, so what is this thing that I'm talking about? Well, the concept is called becoming your own banker, or the infinite banking concept. And by definition, it is the process of creating and controlling the banking function in your life. Why allow banks to profit off your money when you could do the same thing or perform the same function? Now, does it mean you can have your own checking account within this thing? No. You still need a bank, but what this is really this is your warehouse for capital. And if you use it properly, you can eliminate the need over time. Probably like the average takes at least a dozen years to do this, but you could actually have the banks completely removed from your life.
You could eliminate me. You could stop paying interest.
And of course, as we've already been talking, so a very specifically designed life insurance policy is what allows us to do this. Now I'm going to go backwards a little bit here, about this banking function, and understand what it is you're doing. What you're trying to do is create a warehouse for money, or if you liken the analogy of you park your car in the garage. Well, you put your car in the garage, why? To protect it from the elements or whatever. And then when the coast is clear, you back out, you drive around, and you go back in and put your car back in the garage. The life insurance policy is your garage for your money. When the sun is out, or actually when there's blood in the streets, more or less, when it comes to deals, take that money out and invest in your deals, and then safely put it back in when you find that windfall, right? Because you guys are all real estate investors in this room. We're aspiring to be, and there will be windfalls. And when they come, you want to be able to have a place to park your money as well.
A particular windfall would be when the market just increased. Jonathan can attest to this, that houses were going for $150,000 over ask. I had a couple of guys from Ontario refinance a house that they bought in Bedford 4 years ago for $440,000, and it appraised at $900,000. So we took the money out of the property, we took full 80%, and they said, well, how much do I need to hold back for taxes? And I was like, debt is not taxable. You get to pull that money from that asset, tax-free. Same as what he's doing.
That's a real long-term value in this as well, is using this as a retirement income. Again, I'm not going into that today. I tried to kind of keep this
Pared down.
down. Okay, so why infinite banking for savings? These are some of the characteristics of this said life insurance policy: safe, liquid, leverageable, and private. And in brackets there, on demand. What you got to understand too is one of the biggest challenges us real estate investors have is getting financed when you're,
Or running out of down
nosy
payment
credit
money.
applications, all this
Yep.
stuff, so on. So what this allows you to do is it's contractual. When you accumulate money inside of a properly designed life insurance policy, that cash that builds in the policy is basically yours. It's contractual that you call up, and the insurance company, the only questions they ask, well, I need 50 grand. Where
deposit?
send us the bank. Yeah, where do you want us to deposit? And the only other question they may ask is, do you want to make payments on it? Not how
Here's
what
your
are
payments.
what are your payments, or what your payments are. Do you want to make payments? You are completely flexible. So any host flippers in here, it's golden there. Borrow the money, do your work, ignore it, sell your property, pay off the debt. So understand that this is contractual. It's always available to you to borrow against as well. And again, no end date, so no payoff period, no payments. It's protected from tax fees, inflation, losses, and government whims. What's a government whim? This is, I'll talk a little bit of long term. Let's just say, for example, that you're winding down, you want to retire. You're just like, okay, I got this. My rental business is generating $80,000 in income or whatever, but I want 100. So I got this, and Old Age Security has a clawback above $80,000. What that means is it's basically an extra tax. You don't get it. So you say, okay, well, I don't really want to give that up, so how do I do this? Well, you can draw an income from this because it's borrowed money. When you set it, if you set it up properly and structure it properly, take a borrowed, you can take that 20 grand out tax free, still get your Old Age Security as well. So that's a government win, if you will, or just tax changes in general, because this is tax sheltered. It is private contract. And the other thing too with real estate investors, when you're borrowing against an insurance policy, it's not a reported debt. It's not anything you have to report. In fact, actually, you sit there and say, you know, here's my the cash value of my life insurance policy. It becomes cash on your balance sheet when you make your application, even though it's sitting there in cash. You intend to borrow it. The fact is you can redeem it if you want. So it's considered cash when you go to the underwriting table for your loans.
Yeah, because it never gets interrupted. So it's like money that's been there growing the whole time.
So, and you know, obviously, this was kind of a hodgepodge of presentations. It's a little bit repetitive, but you know, why do you want safety and liquidity? Well, access to cash is critical. Banks are expensive, inflation and tax. Stocks and bonds are risky and taxable. These are places you can place your capital. Okay, but the other thing about that I don't put on this thing, those three aspects is control. You are not in control of the value of a bond or a stock. You're not in control of a bank's whims of fees, which isn't even listed there. But basically, sitting in a bank, you know, you basically, you know, you're actually an unsecured creditor to the bank. When you make a deposit, I don't know if a lot of people know this, but when you put money into a bank, you become an unsecured creditor. So, I mean, not that we've got pretty solid banks here, but understand that is really what happens. If that bank was to go down the tubes, you know, you're basically last in line. Life insurance, tax-free, inflation hedged, and risk-free. And you're in full control. Again, the money is yours, or the money is yours contractually to access any time. And finally, going back to this. So, again, this goes back to this graphic you seen earlier is, do you prefer cash or collateral capacity? Cash, lost opportunity costs, as I mentioned, single-use dollars, which Leanne talked about the double use thing, increased risk, and no additional benefits. And again, these are all things that I can cover. Like there's additional benefits you can build around when you build these policies, whether you're you can have a disability waiver, you can have there's several things you can do anyway, and it's creditor protected. And of course, collateral creates that multi-use dollar, reduces the risk and additional benefits. And when I say reduces the risk with collateral capacity, understand what's happening here is if you look at this, what I'm talking about, this cash inside of a life insurance policy, if you think of it like a line of credit, okay, a line of credit has, you know, it's an additional use dollar.
Think of it as a house with no mortgage on it that you can pull from. It's an
Yes,
asset.
so yes, so that's not where I was going with this, but
Yep.
yes, you're right. It's similar because it's like, you know, if you have if you have $500,000 in a life insurance policy, it's almost like having $500,000 in a house. Except the house can go down in value, as we've seen over the past 6 or 8 years. This is guaranteed to go get better every single day. So, for instance, when I talk about the reducing risk, so think of it this way: like if you had a $100,000 line of credit and $100,000 in cash value, okay, and you did nothing with it all year, what's going to happen at the end of the year? You're going to still have this $100,000 line of credit that you didn't use. Over on the insurance side, you're going to have probably $104,000 or $105,000, depending on what the returns are inside the policy, and it'll grow tax-free forever. So it's constantly growing even while you're using it. So if you decide to, and again, flip that again and say you use the $100,000. This is how you magnify returns, and that actually reduces your risk because that's guaranteed to get better. If you did an investment and it made you 10%, you make 10 grand on one side. Over on this side, you're actually making 14 because you got the extra 4 or 5 or 10, 14 or 15, whatever you're making inside the policy on top of the actual investment return. That clear?
Yeah.
And it's
No.
tax-free.
And it's tax, yeah, that side of it is tax-free. The investment, the money inside the policy, it's always growing tax-free.
The big thing with life insurance from a tax perspective is you pay tax once, and once only. So you pay tax before you put it in the policy, because when you put it in, it's not a tax deduction.
That's right.
So you pay tax once, you put it in, it grows tax-free, cashed out tax-free on death. There's never any more tax. If you take any other investment that you can possibly think of, whether it's real estate, stocks, doesn't matter what it is, pay tax once you invest it, pay tax on the growth, you pay tax on the gain, pay tax when you die.
Except for your primary
Right,
residence.
exactly.
Would be one
So
only
you
person.
continually pay tax over and over and over again on all of the growth, right? You're not paying on the same thing twice, but you're continually paying tax on all that growth over a period of lifetime.
So the really cool thing that I'll bring up as well is I have people that are doing this with Scott or whatever. So say they've put $50,000 into their life insurance policy. So what we will do is we'll leverage that. So we'll use that for down payment on 2 properties. We'll verify that money at 2 different lenders, and we'll leverage the money. So the person can leverage against the asset, and then we can also leverage the other property. So the person's not really out any money, they get 2 for the price of 1. And that's how I grew Paul McGinnis from 15 doors to 35 doors in 1 year, was literally leveraging a down payment like that he had that we never used. We just kept using it over and over again.
Which lenders are providing leverage on that cash value? Is it like a conventional
Hey,
lender?
direct, well, there's lots of, you can do it conventionally with, like, banks will basically line up to do this because it's guaranteed growth, so it's like, it's the safest asset out there, really.
But they wanna be
But the
in control
contract,
of the
when I'm
asset.
talking about the control, the contractual, no payments required, that's directly from the insurance company that provides you. That's why they can do it, because they're the lender and the guarantor. So that's why they can do this without any terms, because if you welch on it, they just cancel the policy and take the cash back.
Okay, and what's the spread typically, like if you're earning on the investment and then you're borrowing against it and paying an interest rate, I'm assuming? Like what's
Yeah,
the-
because you're
what's that
borrowing the
delta?
insurance company's money, not yours, so you are paying an interest rate. Typically, well, the one that I use the most is a mutual company, is Equitable Life. They've kept their rate. They have a mandate that they won't lower their rate below their dividend rate. So that's, like I say, it's a dividend paying policy, which is 6.2% right now. And they've kept that while the interest rates have been rising. So some of the other stock companies like Sun Life and Manulife that I use mostly as well, they float. So they'll always be something tied to prime, it's prime plus 1 or prime plus 1.25 or whatever, depending on the size, right? So if you're borrowing more, then the rate will come down. But generally, it's always something tied to prime. So right now they're actually like 6.7, so they're probably right around, I don't know, around between 7 and 8%, right? So yeah, so those ones float. Now, that said, so what it is also available is you can assign it to a bank. A bank will line up to do this because it is guaranteed. So let's just say you were in a situation where you had, I don't know, whatever, Manulife, and they were charging 8%, but you know that your bank will give you a line of credit for 6.5. Well, you can assign the policy and get the 6.5 there, it'll take it in a heartbeat.
I had at Christmas time, I sat next to a Scotiabank wealth banker, and what people in real estate do with these policies and their properties, once they get to a certain level, is they get $5 and $10 million lines of credit against all of their assets, and they're blanketed, and that's how they go buy their foreign property and that kind of thing. So, you know, there's different levels of this stuff, and as you get bigger, the possibilities become endless.
And
Just- sorry, go ahead.
do your premiums match dollar for dollar, like your surrender value? Like say you put a $50,000 premium,
Well,
what's your
it
surrender?
depends on when you're starting.
Oh, okay.
At the start, no. Anywhere from 3 to 5 years in, they actually start to exceed. So, you know, it could be as soon as like say year 3 or 4, you know, you put 10 grand in, it jumps by 13,000. So but yeah, so generally, if it's structured properly, you should have at least 50% of what you deposit available to you immediately. So the day you write the check, if you wrote a $50,000 check, you should have 25 or 26,000 available to you immediately. By somewhere between that point and year 5, you will have exactly what you put in, and then going forward. So when I mentioned the 4 or 5%, that is from day 0. So it snowballs like anything else, like rolling a snowball down the hill. Once you've got it, excuse me, seasoned. When I say seasoned, so that's underwriting, commissions, overhead, and so on. All that kind of comes out ahead. So once that's paid for, then those basically year 5 to 20 becomes like a much higher return annually, but it actually brings your internal return up over time. Does that make sense?
I think so, yeah, I'm just.
Yeah.
All right, we've got time for just like one more question, because I want everybody to be able to intermingle and get each other's info. So any more questions, guys?
So what I'll leave you guys with too is, I'm sure Leanne, you can probably put it on the site there.
Yep.
Is if you send me a message and I can flip back an email, like I have probably not, I mean, some of this stuff will be repetitive. A good starting point is I have a 20-minute webinar. It's just a link, Scott Gannon, actually I can tell you up to scottgannon.com, it's easy to find. If you go there, there's a 20-minute webinar that kind of goes through this a little deeper and actually uses an actual illustration, shows you how the cash flows work and so on. So if you want to see it there,
Awesome.
certainly can.
All right, we're gonna put that up on the site. So, thank you. That was amazing. And like I said, if you wanna get 2 uses for the same dollar, like Scott always says this in our BNI meetings, just give him your money first, and then you get 2 uses for the same dollar. Imagine being able to use your RSPs or your investments while they're still growing. That's exactly what he's doing, and it's quite amazing.
The only
So-
investment advisor that lets me spend money, doesn't just make me give him money.
That's right, that's right.
So, actually-
Jason's doing I've got a whole life policy myself. I spend a lot of money in life insurance a month. I probably like $3,800 a month is what I spend in life insurance. It's part of my financial planning, but it is the richest woman I ever met. Her husband started this 30 years ago with his advisor in Truro, Nova Scotia, and you're making how much a month and you're not paying tax on it? Like, I was like, you're going to jail, like, and that's what it was. It was a Canada Life policy from years ago that had a cash surrender value, and she was basically borrowing against the dividend.
So one more thing there, Leanne brought up about the idea of borrowed money and not paying tax. Like, understand too, I mean, you're all real estate investors in this room, so you're most of the people, or I think all the people in this room are probably comfortable with the idea of debt as a tool to better your life. Like, I've got several articles of, everybody complains about, the Elon Musks and Warren Buffetts and
Donald Trump's.
Yeah, all these people having tiny tax returns, tiny tax bills. It's because they borrow their money.
Yes.
They pledge their assets and borrow it, and borrowed money is not taxable. This is not new. This is just a way to guarantee it. So,
Can you
so
use it
that.
in I'm sorry.
Sure.
Can you use it in the bonded insurance if you're doing, if you
I'm sorry.
had it,
Use it.
like for bonded insurance, for if you wanted to?
Different product.
Yeah,
So you. Oh yeah. Sorry.
no, I'm just wondering if you
wouldn't
could
be.
use it against that, because they look at your assets to bond you for a contractual job, like some kind of.
Oh, well, it can always be shown as an asset, but I don't
Yeah.
think it's not an actual bonding insurance.
Okay. All right. Thank you. So I almost feel bad because we didn't get to do everything, and Jonathan has said that we're just going to leave the market update. So I will post it.
We'll do a better one next year.
We'll do it next month. Okay. And what I'll do is I'll post, because he does do the stats for this area to give us some insight, but the stuff that he has to say around it is good as well. So I'll come back next month for that. I almost feel bad that we crunched you guys into the same night, because the amount of information. The best thing that you guys can do for yourself is book a meeting with these two. Get a small consultation, figure out, they can set you on the right path. And I know this because I've seen people that are not from their time, but that are from a different time, and they're so well off. It's crazy. So thank you for coming. I would just like to go around the room, because we have 5 minutes left, and just to give us your name, your location, and are you starting, or if you're a mature investor. So just your name, where you're from, and if you're new or mature.
Leon, Beaverbank, first property doing Burr.
Excellent.
Same, except for I'm from Sackville. My name's Nick. We're working on it together.
Perfect. MJ?
I'm Murray Cannell, and I am, what does mature qualify?
You are mature. You're a mature investor, darling. Yes. Seasoned.
Seasoned, make some
Yes.
money.
Yeah. You, my dear?
Darlene, pretty new, have one property and looking at maybe getting into this with no help.
Excellent. You, sir?
I'm Matt McNeil. I'm only 20, so I'm just here with my parents and trying to get a head start and learn a little bit.
This is the way to do it. You're in the right room. Jonathan?
Jonathan Benedict, I'm a real estate agent. I run a team here in Windsor that focuses from Halifax to Digby, and I've got 26 stores so far.
Wonderful. Behind him is my husband Randy. He probably won't say anything. You, my dear?
My name's Chrissy, and in a couple of years, so still getting my feet wet.
Excellent. Tim?
My name's Tim Bowman. I'm local here in Hansport, I guess, but I'm just learning right now. Very interested, possibly getting properties quite rapidly. But I mean, just want to know what I'm doing first and foremost. So, and I've talked to you on the phone.
Yes,
too.
I've referred you to those of us.
And we had a video call and stuff, but COVID was tough on the market there for a bit, so it slowed me down. But now things are getting better, so
Good.
hopefully that propels things forward.
Tim also works at Pachi Motors if you need to buy a Jeep or anything like that too. He did, he sold me mine, so. You, sir?
My name's Craig and I'm Chrissy's partner.
Okay, wonderful.
Mary, from Kingston, I own several properties. I started out with one 7 years ago. I now have 9, actually just sold one, so I'm down to 8 on that one. Have an offer in on another one, and I also have a large R3 zoning in the back of Greenwood that I'm looking at doing the park.
Give her.
Kathy Kelly, I'm a relatively mature investor, and I look after properties for a couple other people too.
Wonderful. Sue?
Sue McNeil, and I would say we're still new at investing. Leanne and Scott has helped us immensely over the years, like a lot. So, yeah, we're still dabbling. Scott said we had to get back into it.
Oh, yeah,
after
you're doing
COVID, so
good.
here we are.
Dana?
Dana Prince, I just moved here a year ago. I've got about 5 properties, 3 of them in Ontario, so we need to talk. And we sold our house, so we have more money to really start investing.
Wonderful.
Which makes sense to more dots.
Excellent. Laura? Laura is our event planner. She's the one that keeps me completely going with this stuff, and it's amazing. Noelle?
My name is Noelle. We are short-term rental property managers in the valley. I live in Kentville, and so we manage 30 doors right now and own 3 properties, and also just bought a motel, a 9-door motel. So
She does Airbnb, guys. Tons of it. Yeah. And you guys have met Jason. But just tell us, are you investing in real estate? You're just planning?
Planning right now.
Yeah, wonderful. And Scott, you're a real estate investor as well?
Been investing since 2012, and currently have interest in 2 apartment complexes in Truro. We short-term rent our cottage in Shediac, have a land development in Hatchet Lake, which is debating my existence, and hopefully will be sold this month or next month. And historically, we've basically been around the block doing it all. I do a lot of private lending as well. We did buy originally. We had 22 apartment buildings, 22 units in Florida, and that's how we started back in 2012. And we since sold those. And so
Wonderful.
yeah, I've got done just about everything in real estate so
It's
far.
amazing. So I'm Leanne, I finance properties, I want nothing to do with tenants and toilets. I am building my asset with Scott, and I'm private lending. That's my plan.